Hello, guys. So we'll just be starting in a few minutes. So in the meantime, you guys can check in with the attendance form. I'll also drop a link in the chat. One second.
What's up? Huh? Where? Oh, I'm in RBS right now.
Okay, guys, we'll get started. Okay, so to recap from last week, basically gonna go over what a controller is and stuff like that. Okay, so first things first, a controller, basically someone who has responsibility for all of the accounting related activities, including high level managerial and financial activities within a company. They typically report to a firm's CFO, although in smaller businesses, these two positions of controller and CFO may be combined. So the duties of a controller include assisting with and the preparation of operating budgets, as well as overseeing financial reporting and performing essential duties relating to payroll. So a more detailed look at what controllers actually do is they prepare budgets, they do the collection and analysis of financial data, they manage monthly, quarterly, and annual financial reports, and they make sure that the firm is adhering to generally accepted accounting principles, GAAP, across all business operations. And they analyze accounting reports to guide financial decision-making within the company itself. Okay, so our lesson for this week is going to be financial statements. Okay, so what are the three financial statements? So a financial statement in and of itself, they are written records which essentially convey the business activities and financial performance of a company. They are audited by government agencies, accountants, and firms to ensure accuracy. And other parties who use this information also audit these companies as well. So the statements themselves are used for accounting, tax, financing, and investing purposes. Now, the use of financial statements today is governed primarily by the Sarbanes-Oxley Act of 2002, also known as the SOX Act or SOX. It's a federal law that mandates appropriate financial record keeping and reporting for corporations and publicly traded companies. So looking at the 30 financial statements, let's look at what they actually mean. So number one, we start with it is the income statement. So the income statement, it shows the company's revenues and expenses in a given period, and it includes revenues, costs of goods sold, interest expense, taxes, and etc. Now we have the balance sheet. So a balance sheet, it's essentially a snapshot of the company's assets, liabilities, and stockholders' equity. The most important equation in accounting is this one below, which is bolded right here. Assets equals liabilities plus stockholders' equity, also known as shareholders' equity. So assets is what a company owns, liabilities is what a company owes, and stockholders' equity is basically what the owners of the company, what their value is. And together, everything should be balanced. Lastly, we have the statement of cash flows. So this provides an overview of a company's cash position, the health of how the company is in paying off its operating expenses and making future payments is also analyzed in the statement. So it's divided into three categories: operating activities, investing activities, and financial activities. So here we have some examples of financial statements. We'll go more in depth. Okay, so the income statement. Now, what is this? So the income statement essentially shows a firm's net income for a given period, whether it be a month, a quarter, or a year. In this case, it's a year. And here we have net sales. Basically, that's basically what a company took in, excluding all costs. And here we have costs of sales, and these are basically just costs that a company incurs that deduct from the sales that a company has to get our net income right here. So here we have the revenue, and all of this is basically expenses that a company has to deduct before it can count income. And income is revenues minus expenses. Okay, here we have the balance sheet. Now it looks a little cluttered and it looks like a lot of information, but the basics of the balance sheet is that we have three broad categories by which we designate certain aspects of the company. We have assets, liabilities, and stockholders' equity. Now, remember that the overarching equation in financial accounting is assets equals liabilities plus stockholders' equity. So assets equals liabilities plus stockholders' equity. You'll notice that $770,000 of total assets here equals liabilities, which is $481,000, plus stockholders' equity of $289,000 gives you $770,000. So both of these must add up. So to get a little more in depth about what the balance sheet actually is, here we have current assets. So current assets are assets basically which can be converted into cash within a year. They're generally used up in a year. And then we have property, plant, and equipment, also known as PPE, and intangible assets. Intangible assets are assets that they're basically considered intellectual property. They don't have any physical value. And property, plant, and equipment are basically things that the company owns that help generate value. And both of these things have depreciation expenses as well. Okay, so for liabilities, this is what a company owes. So current liabilities are what a company owes with plans to pay within a given year. Long term is more than a year. Here we have the different accounts that a company has to pay: notes payable, accounts payable, wages, so on and so forth. All of these things are obligations for the company. They must pay them. Here we have stockholders' equity. So stockholders' equity is essentially common stock plus retained earnings. So common stock is basically what the investors own in the company, their portion of the company. And retained earnings is net income. So yeah, net income minus dividends. So net income is broken up into revenues and expenses. So retained earnings is essentially revenues minus expenses minus dividends. Now we add liabilities and stockholders' equity to get the right-hand side of the equation, and it has to match the left-hand side. All right, the statement of cash flows. So the statement of cash flows does things a little bit differently. We look at if the firm is generating enough cash, it needs to pay off its obligations, meaning its operating activities, its investing activities, and its financing activities. So we primarily look at the operating activities of a business because those are what a business needs to pay in order to function, essentially paying its bills, buying inventory, paying its workers, all that good stuff. And a statement of cash flows is for a given period of time. Oh, sorry, just remember this. Sorry, the balance sheet, it's a snapshot in time. So it's not for a given period, like a month or a year or a quarter. It's at a specific date, a snapshot of all of these accounts of what a company has. Okay, so we're going to do a quick recap. So true or false, the balance sheet gives you a company's assets, liabilities, and stockholders' equity for a period of 6 months or more. I'll just tell you guys the answer. It is false. So it's false because the balance sheet is meant to provide a snapshot in time of a company's assets, liabilities, and stockholders' equity. Sorry about that. Okay. All right, and we're basically done. This lesson is not big. We will go more in depth when we have more difficult topics, including management information systems, operations management, all that good stuff within an actual business itself. So if anyone has any questions, feel free to drop them in the chat or unmute and ask them, or you can even take a screenshot of the QR code, go and answer form. It's completely anonymous. And yeah, any feedback at all is fine by me. Okay. All right. Well, if no one has any questions, thank you guys so much for coming out. It's been great. I hope you guys return again next week. Next week, I believe we'll be doing 6 o'clock to 7 o'clock, or sorry, yeah. 7 to 8 p.m. actually. It'll be also on Zoom. I will not be here. One of the controllership committee members will be there. So thank you guys for coming. I will see you later. Thank you, Kelly. You too.